Welcome back to the Global Ledger. I'm Justin. In the last episode, we explored the hierarchy of money, the structure of promises that runs from the Federal Reserve at the top, down through banks, shadow banks, and finally the broader credit system. Today, we're going to look at what happens when that hierarchy comes under stress, when confidence slips, and when some of those promises start to look fragile. In other words, what actually happens during a bank run? Most people imagine a line of panicked depositors waiting outside a bank. But in the modern financial system, bank runs don't look like that anymore. They move faster, they move digitally, and ironically, they often don't involve depositors at all. So today, we're going to break down how a bank run really unfolds, why it often begins inside the financial system, and how shadow banking experiences its own runs, why speed and not fear defines modern crises, and lastly, why the Fed must step in when the hierarchy collapses. Let's dive in. So, let's start with the image most of us grew up with. The long line of people outside a bank branch demanding their money back. That did actually happen historically. You see it in the Great Depression. You see it in old textbooks, and you certainly see it in Hollywood movies. But that's not how the modern system works. Today, deposits can be withdrawn instantly. So money moves electronically. Transfers settle in seconds. And most withdrawals happen between institutions and not customers. So the run, per se, is not physical anymore. It's digital. It's balance sheet driven. It's wholesale, not retail. So it's almost always begins before depositors ever show up. And almost always. So, what's the core issue? And I would put out there that it's the bank's balance sheet. Banks operate on a simple but delicate structure. They hold long-term assets, that's loans, mortgages, securities, and they owe short-term liabilities, that's deposits. So this is called maturity transformation. So it works, well, until it doesn't. A bank run is simply and basically this. I'll give you my best definition. Everyone tries to move down the hierarchy of money at the same time, from deposits to reserves to cash to treasuries. So when the demand for safety spikes, banks must produce settlement money, aka reserves, and quickly. And if they can't, they fail. So not because they're insolvent, but because they can't produce the higher level money demanded in that moment. So the real trigger, I'd say, is a loss of confidence. So bank runs don't start with panic. They start with doubt. Something triggers the market to question a bank's asset or funding stability, like a bad earnings report, losses on securities, declining collateral values, you could say even rumors of insolvency, big withdrawals from major clients, a drop in a bank's stock price, regulators stepping in too late, and losses in interest rate portfolios like we saw in 2023. Once confidence slips, everyone starts climbing up, and they climb fast. And modern bank runs are instant and extremely institutional. Let's talk about SVP. In Silicon Valley's bank collapse, 90% of the deposits left in less than 48 hours. So in 2019's repo crisis, funding disappeared in hours, not days. And another example would be in 2008. Lehman lost access to funding before depositors even realized what was happening. So this is because the first withdrawals in modern bank runs come from large institutions, not households. So these include corporate treasurers, money market funds, hedge funds, large depositors, custodians, foreign banks. When these actors run, they pull tens of billions in a single day. So no line, no waiting, just instant movement. The shadow bank run, more dangerous than deposit runs. But here's the twist. The dangerous bank runs today are not on banks. They're on shadow banks. Why? Because shadow banks create money-like promises to repo agreements, money market fund shares, commercial paper, collateralized lending, treasury-backed liquidity would be another. So when confidence weakens, investors dump these instruments, just like depositors used to dump deposit. This leads to spikes in repo rates, collateral haircuts rising, liquidity freezing, dealers pulling back a little bit, credit markets shutting down, and dollar funding really just blowing out globally. So this is exactly what happened in 2008, 2020, 2008 clearly run on repo, 2020 run on money markets, and 2023 run on regional banks. And what's included in that regional banks was shadow liquidity. So in every case, the run moved up the hierarchy from risky promises to safer ones. So here are the mechanics of kind of a modern day bank run. So let's walk through this sequence together. Step one, a trigger appears. So I'll give some small examples. An example for a small trigger would be a bank suffers losses, or call it rumors circulate. Step two, smart money moves first. So corporate clients, money funds, and institutions pull out huge deposits. Step three, I would say the bank burns liquidity. It uses reserves, sells treasuries, and tries to borrow in wholesale markets. Number four, next kind of step in the sequence, markets sense weakness. And this is kind of when you'll see those funding spreads rise, hedging becomes more expensive, collateral gets haircuts, and credit closes. Next would be the hierarchy collapses internally. Shadow banks refuse repo collateral. Large depositors accelerate withdrawals, and the bank loses the ability to settle. And lastly, I would say that the public run happens last, really, if at all. Only now do households hear about the problem, but by this stage, the bank is already done. This is why I really want listeners to understand modern bank runs are not about fear. They're about balance sheet mechanics. And this is why the Fed has to step in. When the hierarchy breaks, the Fed's role becomes really unavoidable. The Fed must provide the money that lower level promises are demanding. This could be discount window lending, the repo operations, the emergency facilities like the BTFP, the AMLF, swap lines for global dollar demand on the global side, balance sheet backstops for dealer liquidity. It's really important. So the Fed isn't bailing out banks. it's stabilizing the hierarchy. So if the hierarchy fails, everything below it fails. Deposits, funding markets, repo, derivatives, credit, valuation, asset prices, really the entire economy. This is why the dealer of last resort, the liquidity backstop, and the final settlement institution really are just other names for the Fed, and not because the Fed wants power, like I've said before, but because the system cannot self-stabilize at the bottom. I always bring this up because it's important. That removing the fear aspect. What's scary is a mystery, or is mystery, I should say. So what's scary is not knowing how runs unfold. So, but when you see why confidence matters, how banks actually defend themselves, why institutions run first, how shadow banks magnify stress, and when the Fed steps in, the fog clears. Bank runs stop looking like chaos and start looking like mechanical systems, if you will. And mechanics can be understood. And that's the purpose of this show. So thanks again for listening. This was episode 7 of the Global Ledger. And we explored the anatomy of a modern bank run, why it happens, how it unfolds, and why speed and structure matter more than fear. In episode 8, we're going to dive deeper into the system behind these runs, and that is shadow banking. I've mentioned shadow banking a couple times, or many times so far, and this is the invisible system you use every day without realizing it. So this is where things get really interesting. So once again, I'm Justin, and thanks for being here.